It wasn't a trade war. It wasn't a balloon incident. It wasn't even a technological blockade. It was simple arithmetic, the merciless logic of compound growth. Empire is not a steady state. It is a biological cycle. Birth, expansion, overextension, decline. We are witnessing the pivot point, the moment the scale tips. $18 trillion. That is the number that changes the gravity of the global system. For 80 years, Washington dictated the terms. They controlled the sea lanes. They controlled the banking rails. They controlled the reserve asset. But hegemony is expensive. It requires infinite funding. It requires a world that needs your currency more than it needs your goods. That dynamic is ending. The pattern is unmistakable. History provides a roadmap. It shows us exactly what happens when a dominant power faces a structural rival. While drowning in its own obligations, the outcome is rarely a return to the status quo. It is a transition, usually a painful one. To understand where this leads, we must look backward. We must examine the autopsy reports of empires past. We will look at 3 specific cases, 3 dominant powers that believed they were exempt from the laws of economics, 3 societies that found out otherwise. And then we will map those scars directly onto the American balance sheet. Consider the Spanish Empire in the 16th century. Under Philip II, Spain owned the world. Galleons flowed from the Americas, silver from Potosi, gold from Mexico. Madrid was the center of the universe. But the costs were astronomical. Maintaining a global empire required constant warfare. Wars in Flanders, wars against the Ottomans, the Armada. The gold flowed in, but it flowed out faster to pay foreign mercenaries. The domestic economy hollowed out. They stopped making things. They just bought them when the costs exceeded the plunder. The crown chose the fatal shortcut. They debased the currency. They introduced vellon, copper coins mixed with silver, then just copper. Inflation ripped through Costile. A peasant in Toledo saw the price of bread triple while wages stagnated. Landowners thrived. The poor starved. The middle class evaporated. Spain remained a political entity, but its economic supremacy was shattered forever. Just like the Spanish Empire, the British Empire faced the same mathematical wall. By 1914, London was the world's banker. The sterling was as good as gold, literally. But two world wars drained the treasury. To fight for survival, Britain liquidated its foreign assets. They borrowed heavily from the rising power across the Atlantic. By 1945, the debt-to-GDP ratio was crushing. They tried to maintain the illusion of dominance. They kept the sterling pegged. They maintained bases east of Suez. But the arithmetic is merciless. Productivity had shifted to America. Britain was consuming more than it produced. The market eventually forced their hand. Crises in 1947. Again in 1949. Finally, the humiliating devaluation of 1967. A London clerk who saved in pounds for a comfortable retirement found his purchasing power severed. The empire didn't vanish overnight. It just became irrelevant. Just like the British Empire, Rome provides the ultimate template. In the 2nd century, under the Antoninis, the Pax Romana seemed eternal. But the borders were too long. The legions were too expensive. The bureaucracy was too heavy. By the time of the Severan dynasty around 100 AD, the treasury was empty. The solution was always the same. Debasement. They reduced the silver content of the denarius 90%, then 50%, then 5%. By the crisis of the 3rd century, the currency was washed copper. Soldiers demanded payment in gold or goods. Refusing the coin of the realm, prices skyrocketed. Diocletian tried to fix prices by edict. It failed. Markets went black. Society fractured into feudal estates to survive. The centralized power of Rome dissolved not because of the barbarians at the gate, but because the economic engine had seized. The pattern repeats in 7 distinct stages. Stage 1 is the era of sound money and high productivity, where the nation produces more than it consumes and the currency is trusted globally. Stage 2 sees the expansion of public works and bureaucracy, fueled by the initial wealth. leading to a subtle shift in focus from production to management. Stage 3 is the era of overreach, typically marked by military expansion or massive social entitlement programs that exceed tax revenue, forcing the government to borrow heavily. Stage 4 is the pivot point where the debt burden becomes unpayable through honest taxation, leading leaders to debase the currency or monetize the debt. Stage 5 brings visible inflation and a loss of faith in the currency, causing capital to flee into hard assets like land, gold, or foreign reserves. Stage 6 is the rise of a challenger, a rival power with a cleaner balance sheet and higher productivity. That begins to attract the world's commerce. Stage 7 is the inevitable correction, where the incumbent system collapses or is forced to reset at a significantly lower standard of living. Just like the 7 stages of decline in Rome and London, the United States is currently navigating the treacherous waters between Stage 5 and Stage 6. The challenger has arrived, and the numbers are staggering. China's $18 trillion GDP is not just a statistic. It represents a gravitational shift in the demand for commodities, energy, and influence. For decades, the United States enjoyed the exorbitant privilege of printing the world's reserve currency. This allowed Washington to run massive deficits because the world needed dollars to trade oil and goods. But as China's economy rivals the US in size, Beijing is building an alternative financial architecture. They are settling trades in yuan. They are buying gold. They are reducing their holdings of US Treasury bonds. The incentive is clear. Why hold the debt of a rival that is actively weaponizing its currency against you? Some economic historians argue that the US dollar is too entrenched to fail, often citing the lack of a viable alternative or the cleanest shirt in the dirty laundry theory. They suggest that despite the debt, global capital has nowhere else to go. However, this view ignores the mechanics of the margin. A currency does not need to be replaced overnight to lose its potency, it simply needs to lose its monopoly. If global demand for US debt drops by even 20% due to Chinese diversification, interest rates in America must rise to attract capital. That increase in rates blows a hole in the federal budget, forcing more money printing, which drives more inflation. The risk is not an overnight switch to the yuan, but a vicious feedback loop of debt monetization that erodes the American standard of living. History suggests 3 potential endgames for this level of structural imbalance. The first is controlled decline, similar to the British experience after World War II. In this scenario, the US accepts a reduced role, austerity measures are implemented, and the dollar is slowly devalued against real assets over decades, eroding the wealth of savers but preserving social order. The second endgame is chaotic collapse, resembling the Weimar Republic in 1923 or the Soviet Union in 1991. Here, the refusal to address fiscal reality leads to hyperinflation or political disintegration, wiping out the middle class entirely and necessitating a complete rebuild of the state. The third endgame is a reset and restructure, akin to the 1940 Bretton Woods Agreement. In this outcome, global powers convene to establish a new monetary system, likely pegging currencies to a basket of commodities or a neutral reserve asset, effectively ending the dollar's sole hegemony but stabilizing global trade. The only variable is timing and pain. Subscribe to this channel to understand the data as it arrives, and focus your education on financial history and resilience.